Hello and welcome to the second of Burton Sweet's 3 videos on the 3rd of March 2021 budget proposals. I'm Nigel Harris, one of the partners here at Burton Sweet. Do check out the links below to the other 2 videos in this series and also to the budget commentary on our website. If you'd like to click the subscribe button below, you'll be able to check out any further videos we produce as we develop this video channel in the course of 2021. And if you click on the bell, you'll get a reminder every time new content is posted. Okay, so this session is going to look at the company and business tax changes in Rushi Sunaks' budget of the 3rd of March. The highlights, and there weren't that many of them, although some of them are quite significant, are the corporation tax rate increase that's proposed for a couple of years' time, the rather interesting super deduction for investment in plant and machinery, and the 3-year carryback of trading losses. There are some VAT updates which we'll tag on at the end of the session. But let's start off with the corporation tax changes. Currently, corporation tax is charged at a flat rate of 19%. It's the same rate whatever size your company is, whatever size the profits are, from the smallest to the biggest multinational. Which historically has made the UK very attractive for companies looking to set up in this country. The proposal is from 2023 that the standard rate of corporation tax will go up from 19% to 25%. That will apply to profits over 250,000. The 19% rate will apply still to profits below 50,000. So to clarify that, if your profits are 50,000 or less, you'll only pay 19%. If your profits are over 250,000, you'll pay 25% corporation tax. If your profits are somewhere between that figure, then you'll pay 19% on the first 50,000 and a marginal rate on the profits in between. And the effective marginal rate, though, between 50 and 250,000 is actually 26.5%. So as you cross that threshold from 50,000 to the next level up, you're paying a very high rate of corporation tax on that additional level of profit. And that's something that is clearly going to require some planning. Our corporate managers and tax advisors will be working with our clients over the next couple of years to get them ready for this. There is going to be some opportunity to plan for maybe extraordinary capital expenditure. You might want to delay capital expenditure until after the higher rate comes in, then you'll get tax relief at the higher 25%. There's a number of tax planning opportunities, and we'd be happy to discuss those with you if you'd like to make contact with us. Bear in mind also that we're going to see a return to the significance of associated companies. These are companies which either have the same shareholders or where one company owns the shares in another company, say in a group situation. In those situations, the 50,000 and 250,000 thresholds are shared equally between all those companies. So take a simple example. We've got a number of clients where they have 2 different companies. They have 2 different activities and they've decided to register 2 companies, same ownership. So in that case, each of those companies will only pay 19% on profits up to 25,000, one half of the limit, because it's divided between the number of companies. So on profits over 25,000, they'll be paying the marginal 26.5% rate of corporation tax. Another tax planning opportunity here to look at those companies and say, well, in fact, do we really need 2 companies? Maybe it's time to move all the trade into one company and avoid this issue, get rid of the other company. So a number of tax planning opportunities, but with a caveat that I should point out that it's been mooted in a number of places in the press, that of course, this change only takes place from April 2023. There's going to be a few more budgets before now and then, and this may be just a warning shot over the bows from the Chancellor, who, when the time comes, may decide not to implement this change. This is not set in stone. He could resume 19%. He could have any rate he wants from 2023, or indeed from 2022. So this is one of those advance warnings that may or may not happen. We're going to be planning for it, but always being aware that the actual rate or the date of change may be different when the time comes. Now, something that works kind of in tandem with this is this rather interesting announcement of a super deduction for the investment in plant and machinery. Because with the increase in the corporation tax rate in 2023, it's going to be very tempting for companies to delay major investment until then, because from 2023, they're going to get corporation tax at 25% on any investment rather than 19% at the moment. Now that's quite attractive, and that might encourage companies to actually mothball plans. So the Chancellor has come up with this new and rather unusual capital allowance, whereby between the 1st of April 2021 and the 31st of March 2023, you're going to be able to claim up to 130% tax allowance on new plant and equipment, including commercial vehicles, but not cars. In other words, what it means is that if from April 21 onwards you spend £100 on new machinery, you'll be able to claim tax relief on £130. So that's quite attractive. That's giving you a much higher rate of tax allowance. And this also works quite attractively from an accounting point of view, because it doesn't affect your reported profits for accounting purposes, but it enables you to report a much lower profit for tax purposes, meaning that investment in new plant and machinery reduces taxable profits, but maintains or retains a higher level of distributable profits for dividend purposes. So you kind of get the best of both worlds. Unfortunately, this does only apply to companies. It doesn't apply to sole traders or partnerships. Little bit of advantage there for companies. Clearly, those are the businesses which have got unlimited spending capability. Now, this is an unlimited allowance, so very attractive for groups where at the moment the annual investment allowance, which you'll see noted there, is going to continue at £1 million for the rest of 2021. It would have gone down to 200,000 otherwise, but it's been retained at £1 million. But that £1 million is shared between all the companies in a group of companies. So only that £1 million is available across the whole group. And once one of the group companies has spent £1 million, nobody else in the group can claim the annual investment allowance. The super deduction, though, is available without a financial limit between all the companies. So within groups, this is going to be particularly advantageous. And I can see some fairly heavy investment in group companies where they can gear themselves up for the future, for the period post-coronavirus, etc. So a very unusual one. Do note, though, that the super deduction is only available for new and unused plant and equipment. Normally, capital allowances are available where equipment is new to you. It can be second-hand, and in the case of commercial vehicles, very often they are second-hand. The super deduction, it must be brand new equipment. The second big announcement, and this applies to both companies and sole traders and partnerships, is the 3-year carryback of trading losses. Now, normally, when you make a loss in 1 year, you can carry it back to set against the profit of the previous year. And if you do that and you pay tax the previous year, that generates a tax refund. Now, that's always been the case. That's the normal rule. What the Chancellor has announced is that for the current periods for companies and for next year, the carryback is going to be extended over another 2 years. So instead of being able to carry back a loss for 1 year, you can carry it back for 3 years. Now, for limited companies, as it says there on the slide, we're talking about losses incurred in accounting periods ending between the 1st of April 2020 and the 31st of March 2022. So in the case of companies, these are years which have already ended. And we've already had a number of our company clients who've been able to claim the loss carryback and claim the tax refund that is generated by doing that. For sole traders and partnerships, we're talking about losses arising in 2021 and 21-22. Those can be carried back 3 years. Now, the rule is that the losses have to be carried back using the latest year first. So you carry back to the previous year. If there's any loss left over, you can then carry that back to the year before and the year before that. So you're going backwards in time. There is no limit to the amount of loss you can carry back 1 year, but if you're carrying back losses into the second or third year, there's a maximum of £2 million of loss that you can claim in those 2 earliest years. And in a similar way to the capital allowances, in the case of a group, the £2 million that can be carried back into the second and third year, that's a limit across the entire group. So that £2 million limit has got to be shared. Is this a good idea? Well, of course, taken into account with the increase in corporation tax in 2023, this may not be something that suits everybody. It may actually be better for some companies to keep their losses that they're making while trade is depressed during the coronavirus period, carry them forward and use them against profits in 2023 onwards when the corporation tax rate is that much higher. Bear in mind that the increase in corporation tax from 19% to 25% in money terms represents a 32% increase in the amount of tax which is going to be payable, and that's a big and bitter pill to swallow in 2023. So if that does happen, it may be that you're better off retaining your losses. Unfortunately, it's going to be a bit of a gamble because you may well need to use those losses before we find out whether the corporation tax rate is actually going up. Something to discuss with the corporate managers here at Burton Sweet. We'll be able to do the cash flow projections for you and advise you what your options are. Obviously, we don't have a crystal ball, but we can give you your options and help you make a decision. The final change for businesses is a couple of things for VAT. There were some rumours before the budget that the VAT registration limit would either be increased, because we do have that opportunity now we've left the EU, or on the other hand, there were fears that maybe the registration limit would be reduced, because historically we've always had the highest registration limit amongst European countries, and in fact in many EU countries there is no registration limit at all. You register for VAT when you register a business and everybody pays VAT. Level playing field, but a lot more administration. At the moment our registration limit is 85,000 and that is going to continue till at least 2024. A change for some of the smaller businesses is that Making Tax Digital, MTD, for VAT is going to be applied to all VAT registered businesses from April 22. At the moment, Making Tax Digital for VAT only applies if your turnover is over the 85,000 VAT threshold. But if you've got a smaller business which has registered voluntarily for VAT, you don't need to apply MTD. Now, what does this mean? Well, what it means is that under MTD, you've got to maintain your VAT records digitally. Now, in most cases, that's going to mean using some accounting software to do it. It is possible to do it using spreadsheets. Frankly, it's a complicated thing to do. It is cumbersome, and you may think you're saving a bit of money, but I would suggest that investing a relatively small amount of money in some online software such as Xero, QuickBooks Online or Free Agent in the long term will reap a whole load more benefits in terms of the control you've got. You may even save some money at the end of the year with your annual accounts because you're doing your accounts as you go. But the Making Tax Digital requires you to keep digital records and to submit your VAT returns using the MTD gateway through the software. Do have a word with us as soon as you can. This will come in for all businesses from the 1st of April 22 if you're not already included in Making Tax Digital. You do need to prepare your record keeping, consider how you're going to do it, and our small business managers will be more than happy to talk you through your options. There was good news for the hospitality and holiday businesses in that the 5% reduced rate for VAT has been extended to the 30th of September 2021. Now, clearly, most of those businesses are not getting much, if any, benefit from the 5% rate at the moment because they're all closed down, but they will be opening up over the summer, and that means that the summer and the school holiday season for 2021, you'll be paying 5% in restaurants, hotels, holiday accommodation, caravan and camping sites, that sort of thing, and all the holiday attractions, parks, safari parks, etc. Then we have some slightly bad news for bookkeepers in that we're going to have a 12.5% VAT rate for those businesses from October 21 to the 31st of March 2022. So yet another VAT rate for us to cope with. Don't be too concerned if you're using VAT software, because I'm sure that additional rate will be incorporated within the software by the time that comes into force. But it is something that you'll need to look out for. Bookkeepers will need to be alert to that change of rate. You might need to do something within your record keeping to do that. Make sure you don't pay the incorrect rate of tax. We'll resume the standard rate of VAT from April 2022 for everybody. But a useful concession, I think, for hospitality, holiday attractions, and obviously very welcome for those of us that are going to be making use of those facilities. Final VAT announcement was something we knew already, but I'll just remind you that if you deferred your VAT on the first VAT quarter of 2020, this was typically the quarter January to March 2020, where you had the opportunity when you filed your VAT return not to actually pay the VAT. You had until the 31st of March 2021 to pay the VAT. Well, the good news is that the Chancellor has said that you now have another year to pay that VAT. So it only applies to that first quarter of 2020, or the first return rather that you filed in 2020. But you can now pay off that old VAT liability in instalments up to the 31st of March 2022. Now, 31st of March 2022 is an absolute deadline here. So the sooner you make the arrangement with HM Revenue and Customs to do this, the better, because it will be spread over the months between now and March 2022. So the longer you leave it, the fewer months you've got basically to spread those arrears over. Just a word of warning though, that it has to be the taxpayer that phones HMRC and makes this arrangement. We unfortunately can't do that for you. Tax agents and accountants are not allowed to make this arrangement on behalf of their clients. Having said that, if this is something that you'd like to do, then do contact the business managers here at Burton Sweet, and we can give you the number and explain how to go about doing this, but you will need to make that phone call and do it yourself. You may well need to set aside an hour and make yourself a cup of tea or coffee while you're waiting for the phone to be answered at HMRC. They are going to be pretty busy, but I understand that it's not difficult to make this arrangement. It's an open offer to all businesses. You don't have to qualify for it or anything. Make that arrangement and spread that liability. It would at least ease your cash flow between now and then. Those are the business announcements in this year's budget. If you've got any questions, my contact details are there. Do by all means get in touch. Be happy to answer any questions. And then do look out for the other two videos in this series. And thank you very much for joining me.